Hello, ladies and gentlemen, and a very warm welcome to you in today's session, Unlocking the Potential of Fixed Income in Today's Investment Landscape, presented to you in association with Mirae Asset Mutual Fund. And as the name suggests, fixed income funds typically invest a significant portion of your portfolio into fixed income securities like government securities, debentures, corporate bonds, and other fixed income instruments. These funds are highly sensitive to interest rate movements. When interest rates go down, the value of these bonds tends to rise and vice versa. As an investor, you can park your money in fixed income funds for the long term or short term, depending upon the tenure of the fund you have chosen. But it is important to remember that long duration debt funds are more sensitive to interest rate fluctuations as they invest into bonds with longer maturities. As prevailing interest rates are high, an investor can take advantage of these levels and lock into the rates now, keeping in mind a long-term investment horizon and not worry about reinvestment risk. On the lineup for today's discussion is a distinguished speaker, Kruti Chheta, fund manager and fixed income analyst of Mirae Asset Investment Managers Private Limited. Ms. Chheta brings to us a wealth of expertise on the subject of fixed income funds. So without further ado, let's begin the discussion. First of all, thank you so much, Kruti, for giving us your time. And let's start with the absolute basics for our viewers. What exactly are the fixed income or debt funds, and how are they different from other kinds of mutual funds in the market?
So there are various asset classes that are there for investors to invest in, and the most commonly known to an investor as is an equity asset class, where investors take exposure to the part of the ownership of the company. And in mutual funds also, this is largely a category where retail investors are more interested in. The ignored asset class from the retail perspective right now is a fixed income asset class, where we see that it's more corporate heavy or it is more HNI heavy at the moment. Fixed income asset class is essentially, to put it down very simply, is let's say for a very layman language, that there is an individual who is going and taking a loan from the bank, and that individual is taking a car loan, say at 8% or so on. So when he's taking a loan, he's essentially borrowing money from the bank to create an asset. Similarly, the corporates do the same. They borrow the money from the markets. These are the debt capital markets. The corporates borrow it and they put it in their asset creation, or whether they need it for the working capital. So depending on the need, the tenure of the loan varies, and the corporates come from various tenures. So to put it very simply, if you are taking a car loan, it could be a minimum of 3 years because it's a short-term requirement. But if you're taking a housing loan, it would be for a longer period. So similarly, corporates come into the capital markets. If they want something to borrow for a shorter term, which is their working capital, then they would probably borrow for a 1 year or a 3 year. But if they want something towards an asset creation, then they would borrow for a 10 year or they would borrow for a 15 year. So as an individual, when you're investing in a fixed income, if you're investing in a particular security, then you're investing in a corporate itself. But if you're investing in a fixed income mutual fund or any of this category that you are going for, then you're investing in a pool of corporates which are borrowing from the investors in order to create, asset creation or their normal workings, day-to-day workings which are there.
All right. But when we talk about debt funds, we know that there are a plethora of options available in the market. So how can an investor decide which one to go for, which debt fund to invest into?
So if you see, debt category is a very beautiful category because it has something for everyone. Now, if I know that I need something in 3 months, I have a category called liquid and liquid plus segment, where I can invest for, let's say, 7 days also, and I can invest for 3 years also, right? Okay. So it depends on your need. if you are an investor and you need a liquidity, it is similar to keeping it in your savings account, but you get a liquidity much faster and you essentially get accrual plus the benefit of the market movement into it also. So instead of a savings fund, you can simply opt for a liquid fund. But let's say if you are an investor who sees that I don't need this money immediately, but maybe I need after a year. Maybe you are, putting your money aside for a trip that you're planning in next 6 months or 1 year. So you can go for a liquid plus products, which is an ultra or a low duration category, which are essentially 1 year product. Similar concept that, you are getting accrual on that product, and at the same time, you can take the benefit of the market movement and get some capital gains also in it. But if you are an investor who's looking that I have a child and I need to, sponsor the education for in next 3 years, he's going to go in, I have the corpus, but I don't want to move that corpus much, I don't want to put it in a volatile asset class, I need it to be safe, but I need that, okay, you always want your money working for you. So you can go for a product essentially which is like a short term category, which is 3 year, or a corporate bond or banking PSU category, which is 5 years. Depending on your horizon and depending on what is your need, there is something for everyone in that category.
All right, but we know that with every investment comes return risk measure.
Absolutely.
And that must match with that of the investor also. So my question here is for you is, what kind of investors are very well suited for long duration funds?
So when we talk about long duration fund, essentially we are talking about taking a call on an economy, right? We're taking a call that where is the country headed, and in a current situation where we are seeing that India is becoming a structural story, we have seen that in a lot of narratives of equity, that it is a consumption heavy economy, we have built it over a period of time. So for an investor, when they're looking for a long duration fund, essentially they're looking to lock in the interest rate at these levels, because what we see down the line is that today what you are locking in at 7% probably is tomorrow not going to be the case, because as an economy fundamentally we would have changed, and we've seen a lot of economies in South Asia itself which are less diversified than India are at a lower interest rate. So we believe that the fundamental is set in, and not that India has not a proven record. We have seen that India has come a long way from having an interest rate of 12% to 8% to now we have stabilized to a certain level. But essentially when an investor is looking at a long duration, it is looking at a structural story. And what is the investment aim for an investor to invest in a long duration is that down the line, when I am planning my retirement, it is a stability of income that it provides me. So I am taking the benefit of the higher accrual by locking in my yields at a higher accrual, and at the same time, because this is going to be a premium product, you've invested much early on in a product, right? If you had invested in Infosys, it was a premium product back then, and now you reap the benefit of it. So similarly for a debt market also, when you lock in at such premium yield, you tend to get the capital gains going ahead also, and you continue to get the good accrual on the same product. Therefore, an investor who is looking at the stability of income in their retirement, or they're looking at funding their child's marriage or child's education in a long term where they need stability, this is the product to look at.
So you're mentioning, in a way, you're saying that these funds can be considered as part of their core portfolio.
Absolutely. This can be a part of core portfolio in a long run, where you know that the other assets might be volatile, but this will be there as a safe haven where you can create an easy liquidity any point of time.
But is there a minimum lock-in period that you recommend for a fixed income investment to maximize its returns?
For any investor to maximize their return, they need to see a cycle, any asset class. So if an investor is staying through an interest rate cycle, which is typically a 3-year cycle in any of the economy, which is it can vary, but we are just saying on an average it's a 3-year cycle. So for any asset class, that is the period of time that you need to give. But when we are talking about a long duration product, and we are talking about staying invested in it, the duration itself is a 7-year for the product. So we would recommend that any investor who has an investment horizon of more than 5 years should look at it on a structural level as a core asset allocation. But if an investor is here to play a duration call and is a very learned investor and knows the interest rate cycle, they can take it as a tactical call also in their portfolio.
We noticed that you use the word accrual a lot of times here. So can you please explain the term accrual as well as capital gains when it is associated with fixed income securities?
So when we say accrual, we mean, okay, let me again put it in a very simple example over here. As a customer, if I'm going to take a loan on a car loan, there are two options that are given to me, that you can have a fixed rate and you can have a floating rate. If I have any sense of the market and I know that interest rates are going to go down, I will say that I'll take it at 8% right now because it's my requirement. But I know that interest rates are going to go down going forward, so I will go for a floating interest rate because that will bring down my component, right? But if I have any side that says that the interest rates are going to go higher, then the bank will try to sell you a fixed rate, right? Floating rate, but you will want to take a fixed rate. Okay, so as an individual, when you are investing, you know that interest rates are going to go lower, you lock in at 7%. So that becomes your fixed rate. That coupon becomes your fixed rate. And as the interest rates go down, so this 7%, let's say in India, the GSEC bonds used to get issued at 8.5%. Today they are getting issued at 7-10 handle. Tomorrow, going ahead, maybe they'll get issued at 6.5%. But if you have locked in at 7%, that means that you are getting income of 7% for next 10 years that you have locked in, or next 15 years or 20 years or so. So that is the accrued, or that the coupon, that accrued interest that comes in for you every year. Vis-a-vis the market movements, it doesn't matter if it's going down for you, but you are fixated on it. Now, when I say capital gain is that if I have locked in a security at 7% and tomorrow government bond is getting issued at 6.5%, that means my security is becoming valuable, right? Because the coupon offered by the government of India is now lower at 6.5%. So probably a face value of 100 over here and a 7% coupon which is there, it's a 50 basis benefit that you are getting. That means that my security pricing will go higher, and that is where a capital gain comes in the security if you are locking in at a higher accrual for yourself.
All right. Now, Kruti, is investing into debt funds through systematic investment planning or SIPs an advisable strategy for retail investors in India?
In any asset class, systematic investment plan is a good strategy, because we have known, and the veterans itself say, that there is never a right or a wrong time to invest, and through the volatility you will never know what is the right time to enter and what is the right time to exit. So in order to catch all the market volatility and make the most of it, systematic investment plan makes a lot in debt funds also, because there are markets where there will be opportunities. Something happening in the global, like the current situation is happening, gives you an opportunity to lock in at a higher levels at every point of time.
Well, let's talk about the risks. What is the reinvestment risk in fixed income investment, and also how significant it can be while investing in fixed income avenues?
So reinvestment risk is essentially that tomorrow if something goes wrong and government decides that the 7% becomes 7.5% because we don't have enough investors, so they have to give a better price. That is your reinvestment risk, that you locked in at 7%, but the new issuances are coming at 7.5%. So investors would probably go in for a higher yield per se, and from that point of view, the security which was premium now becomes discounted. So in such a situation, what would you do essentially as an investor is also that you would sell it at a lower price and move to a higher coupon security. That's going to be there with any asset class. But essentially when we say for a fixed income, volatility is much more narrowed down than the other asset classes. Therefore, in an asset allocation, we say that fixed income products are which provide stability rather than more of a risk into the portfolio. And when your other wealth creating asset classes are moving or is against the cycle, this could provide a good liquidity stability to your portfolio.
Nice, and let's talk about the benefits now, and that brings a smile to your face as well. Can you enlist some of the key benefits of investing into long duration debt funds, considering, especially given this current macroeconomic environment?
So, current macroeconomic environment has become volatile, but we say that every volatility is an opportunity. So tomorrow, where we were seeing a straight line, if there is some of the bumps that are coming in, it gives the investor a good entry point to come into the markets and make the most out of it. And speaking of macro volatility, lot has been right now an assumption. Only when things turn out to be in an action, we will see that how the situation turns out to be. But if we have to see in a hindsight, the path seems to be very clear on the global front also, and also on the domestic front. And few reasons for that is that we see in a global perspective, the growth slowdown has been accounted by. IMF has given the estimates lower. We see that unemployment is at a high, and if it's going higher than here, then central banks would have to cater it. And inflation has been a story for a couple of years, but now we see it stabilizing. If not going down drastically, it is stabilizing at current levels. Speaking of domestic, we have seen stability on various fronts like fiscal, inflation, current account deficit, which we were most worried about in the past. We've not been worried about it recently. So we've been waiting for inflation to settle down, but a new development that is coming in, which we are not addressing right now, is the growth. And we want to go and move up the ladder to top 3. Right now we are top 5 economies. We want to go to the top 3. When we want to move to the top 3, the fundamentals change, the structure change over here, and 6.5% is not something that we can reach top 3 with. The estimates say that we need to be at 15% nominal GDP growth. We've settled at 12%, but if we are settling at 6.5, it would be lower than 10% essentially. So then there has to be the incentives which have to come in, and these incentives generally for any economy we've seen in sense of rate cuts, or government capex is already coming in, but if you have to get in private capex, which has not happened over a period of time, how do we get that to happen? And this is the starting point which we see, apart from government incentives coming in, that interest rate comes down and we see that the economy starts moving in the right direction. Therefore we see there is a case that India moves down the interest rate cycle in the upcoming year. And speaking of structurally also, the consumer patterns have changed in India a lot. We've seen that the shift has moved more to SUVs. We've seen that there are now more personal loans that are being taken by people for more discretionary spends. We see that the travel is moving. So definitely India consumer pattern is also changing, and when we see that the consumer pattern is changing, that means that the country is getting ready for the next move. Therefore we see in a longer run, the structural interest rate cycle that we have seen that currently is somewhere parked between 6.5 to 7% would move down to like a 5.5% 5% eventually over the period of time. Therefore from a structural perspective and from a long story, we repeatedly say that equity India is a consumption and a long story, and same way for a debt also India is a structural story. Therefore a long product for a stability of your portfolio and making maximum of it suits for an investor to make it as a core product of the portfolio.
Then how should an investor approach rebalancing their long duration portfolios in a dynamic interest rate environment?
Investor, the benchmark CRISIL long duration fund, and we've just seen the backdated data of it. If an investor is truly on a long product, and we've seen that the India has moved down the interest rate cycle, on an average makes an 8% through all the interest rate, going through all the interest rate cycle. We've seen that it makes an average of 8% CAGR over the period of years staying invested in fixed income products. But an investor who knows the markets and wants to play these markets can take tactical calls, can take a 1 year horizon, 1.5 or 2 year horizon, play through the interest rate cycle. But if you are a long investor, then stay invested, ignore the volatility, because the path, there could be a volatility. But if you're an investor who likes to play through the interest rate cycle, then you can take the call on where the interest rates are headed and take a added benefit if you're aware about the markets.
All right. And lastly, looking at the future, what is the outlook for the fixed income funds, especially considering the factors like changing interest rates?
For fixed income, the last year has played out as a demand-supply dynamic, and I would just like to say that the next year is going to be an added benefits with the rate cuts. So the demand-supply dynamic plays out as it is, and we will have an additional benefit of interest rates coming in, which will prove to be again a benefit for the returns of the fixed income product. Last year, the investors have missed the rally and have missed on the double-digit returns on the fixed income product. But with this year's volatility that has come in at this time, investors have just got another opportunity to make the most out of it.
Well, that brings us to the end of the discussion. Thank you so much, Kruti, for sharing your insights and giving us your time. Thank you so much for joining us in this session, Kruti. And thank you, viewers, for joining us for this session. But before we sign off, I would like to thank Mirae Asset Mutual Fund for partnering with us for today's session.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.